Right, I think I'm oh yeah, I think it's definitely working now. Okay, and then oh yes, share. Here we are. Copy C. Okay, it's definitely working now. Gosh, we've got it. Reply. Okay, I think this, if you click on this one, I think then this one's on air.
Right.
Okay, because it says stop broadcasting at the bottom.
Oh, okay, yeah, that's one. Okay, I got it.
And then how did I do my share screen on this thing? Oh yes, it was. Oh yeah, I've got the share screen. Yeah. Okay, I think we've done it. Well done.
Great. Okay, I can see it.
Can you see me? Oh yeah, I've got Anna now. I can see you. Yeah.
Oh, it looks quite different this screen.
Does it?
It looks quite different.
Why?
Got all the buttons and stuff outside.
Yeah. It's got, mine looks a bit, I've got much more gadgets to play with. Oh, you know, I mean, if this thing is this easy. Oh, he didn't want to record it, did he? I was just thinking that Xavier thing.
Oh, yeah. Oh, yeah, he didn't want to.
No, he doesn't want to record it. I can't hear you on the mic. Why can't I hear you on the mic?
What, so you can just hear me on the speakerphone? Well, because I've not got a mic enabled on my PC.
Oh, okay.
It's just, I have to connect my headphones to it. It's not got those connected.
Okay, fine. That's
I think that works. My PC's just not great.
Okay, so we just need this guy. Crispin, is it? Yeah, Crispin needs to join.
Yeah. Hopefully he'll be there with you in a minute.
Yeah, you sent him the new link.
Yeah.
Right. Okay, ready to go. Ready to go. I've got my slides. And then, so the Xavier thing, yeah, you think you'll be able to organise that?
Yeah, I'll wait for him to get back to me. Crispin.
Hello.
Oh, great, Crispin.
Hello, fantastic.
I can hear you as well, and I can see you.
Brilliant, excellent. We got there in the end. Sorry about that.
Now, you realise we're on air.
Yes.
So you can actually log into YouTube and you can see our conversation. It's all very exciting. It's the first time I've done this.
Right, I can leave you to it, James. I'll see you later.
Okay, yeah, great. Okay, Anna, thanks.
Bye.
Bye. Right. Okay, Crispin, great. Yeah, I can see you very clearly, yes.
Excellent.
Right, this calculation 5.3.
Yeah.
So I thought we're just going to talk about that particular spreadsheet. Yes, is that okay? Yes.
That's fine. That's fine. Yeah.
How is your statistics? I've just got 3 quick slides to go over mean, standard deviation, and correlations, because that's all that's needed.
Okay.
Yeah. So you've got to tell me if we'll go through it very quickly, or tell me if you know it already.
Probably not. No, I mean my statistics isn't great. And I don't remember any. I haven't done statistics for years and years, so it's a long time.
Okay.
Oh, hello. Okay, cool.
Can you see me now? Can you see the slides?
I can see the slides. Yeah.
Okay, great. Well, we'll just go through these slides really quickly, and then we'll go through the spreadsheet.
Okay, fine.
Yeah, and if you don't understand anything, I can hear you really clearly, so you can just interrupt me and stop it. Yes.
Brilliant. Okay, we'll do.
So all you need for this spreadsheet is just, you need to know how to calculate the mean, the standard deviation, and the correlation. So I've got one slide on each of those.
Okay.
Okay, it's a little bit mathematical, but you know, it's hard to avoid a little bit of maths. So what we're saying, I've assumed as we have in the spreadsheet that we've just got this return series, R1, R2, R3. So that's just the return in, you know, January 1970, and R2 is the return in February 1970. R3 is the return in March 1970, and so on all the way down. Yeah.
Okay. Yeah. Sure.
Yeah. And the mean, well, that's the easy. It's just the average.
Yeah.
So the mean gives you a measure for what we want is of the average return. So let's say you invest in the FTSE 100. This is what you could expect on the average return every month to be.
Yeah, that's fine.
And what you would like to know what it was really what really the average was, but no one knows. And so what you try and do is estimate it from past data. So that's quite important.
Okay. Just sorry, James, just quickly. Yeah. Are we on slide 1 or slide 2?
It's slide 2 here.
I'm only seeing slide 1 at the moment.
What's slide 1?
Well, just the first page, a picture of Imperial. Do I need to slide down, or can you?
Oh.
There we go. I've got it.
But if I just went to live, or maybe I have to. Okay, maybe I can't do. Anyway, you can see it now. Okay.
I can see it now. Yeah, because what I'm looking at, it looks like I'm looking at, it's PowerPoint, isn't it? So maybe you need to go to slideshow itself rather than.
That's what I did, and then you said you couldn't see it.
Ah, right. Okay. No, I'm just looking at as if I was looking at PowerPoint, as if I was doing it myself.
I know. If I press slideshow, which is that, what can you see now?
No, it's still the same. I'm just looking at. I'm looking at the bar down the left.
Okay, the slideshow doesn't work. That facility doesn't work in this Hangout.
Okay, but I can see it now. I'm on page 2.
Let's just go on. Okay, as long as you can see it, yes. Yeah. And can you see my cursor move around?
Yeah, I can see that. Yep.
Oh, okay, that's quite useful. Okay, so these are the returns. Yes.
Yeah.
Over our period of observation. What we're going to do is calculate the average of those returns. And then the big assumption you always have to remember with these things is then when we go forward and you're trying to invest, is you're kind of assuming the future is going to be like the past. And that's obviously a big assumption.
Yeah.
And, you know, in the end, it catches all of us because the future is never the same. But anyway, so the average is just a straight. You add them all up and divide by the number of observations. So that's very easy. Yes, that's this line here. And then this is writing in a slightly more fancy notation, the sigma notation.
Okay.
Where
so essentially that notation on the right is effectively a simpler way of writing what's on the left. Is that right?
Absolutely. It's just a mathematical way of writing what's on the left. The sigma means sum up. And then you got I equals 1 to n. So that means sum up all the terms after the sigma from 1 into n. And the term is Ri. So you're summing up R1 plus R2 plus R3 plus R4 and dividing by n. So that's how that notation works.
Okay.
Yeah, that's why I wrote it out longhand. I was a bit worried about that notation. Okay.
Okay. Sorry, n is the number of
observations.
Right.
Okay, that's up here. So you've got n observations.
So in this month we're doing a year, so that's 12 months. So n is 12. Is that right?
Well, no, it's from actually on the spreadsheet is from 1970 all the way through to 2015 monthly observations.
Ah, okay.
Okay.
Right, yes.
In that case, it will be 46 times 12.
Right. Yes. Okay.
About nearly 500.
The total number of observations you've got in there, effectively. I was saying 12 because I thought it was just 1 year. So if it was 1 year, it'd be 12. If it's
with 1 year, it'd be 12. But yes, if you got
Okay.
Okay, and then we call that average R bar, and that's standard notation. You just put a bar over it and say that's what that number is.
Okay.
So probably for the FTSE 100, it's probably around about 6-7%, 0.06, 0.07. Yeah. Oh no, so this is monthly, so it'll be about 0.01. Okay, that number R bar will be about 0.01, which is the average return you'll get every month if you invest in the FTSE, about 1 and a bit %.
Yeah. Okay.
Now, what we always do is, because you can observe returns monthly, you can return weekly or even daily.
Yeah.
And obviously the mean return will change depending on what period you're measuring it over.
Okay.
But so we always express it in an annualized way. So we put it on a common basis. So we know, look, what is the average return over 1 year? And that's just a convenient way that we're always using the same period. We kind of have the same numbers, and it just makes it a lot easier sort of to communicate.
Okay. Here
the series is monthly. And the great thing about it is you have 12 months, and each month is giving you a 1% return. Then the return over the year will be 12 times that. You've got 12 months, yeah?
Okay, yeah.
To annualize it, you just multiply it by 12.
Yeah.
If you were observing it weekly, you would multiply it by 52. And if it was daily, well, we normally assume dailies, and you've got to be, we normally assume the business days in the year, so we take away weekends, and we usually use a number around about 252, 260 to annualize.
Okay.
Yes?
Yeah, that makes sense.
You're good with, yeah, so that's the mean. And being an investor, that's really what you're concerned with most, what return I'm going to get. Yes?
Yes, that makes sense. Okay.
Now, then the standard deviation is a measure of the risk. So now you know what your average return is, but what you want to know is how much risk are you taking on, how much volatility are you facing if you invest in the FTSE 100. Yeah, so it's like your average is going to be 1% per month, but it could be plus or minus what? Do you get some months where it's +3 and some months where it's -3, or yeah?
Okay.
Or is it? Do you see months? How often is it? Do you see months of +10 and -10 and so on? We want to get an idea of that spread from month to month.
Okay.
And that's what we measure by the standard deviation. Yeah.
Okay, I get that. Yeah, I get that. Yeah.
Yes. And so we're measuring spread now. We're measuring range. Okay. And so what we do is, and that's that first expression here. What we're doing is, from each monthly observation, we're taking away the mean. Yeah, R1 minus R bar. And we do that over all our different observations. We take away the mean. So now we're looking at a series that has no mean. It has a mean of 0.
Yeah.
Yes. And we square it. Yes. Because that means that if it was, now we're adding a number that's always positive. So if it was a really bad month and the return was minus, let's say -3, we take off the mean, which is 1. So we end off with, it's -4% lower than we would normally expect from the mean. We square it, and now now that becomes a positive number.
Okay.
Yes. And we can add that up over all our observations, and again divide by n. So it's all these are positive numbers. We divide by n, and you can see that's going to be a measure of the volatility of that series. That number's, yeah, and the more volatile it is, the more it's going to deviate from the mean, the bigger that number is.
Yeah, okay, I get that.
And you take the square root of it, because you squared it to square root it to put it back into return units. Yeah, because you squared it up. You then take, at the end of it, you take the square root again, and that puts it back into, if you like, return units. And that is a measure of how much the return series is moving from one month to the next.
Okay.
You can now do an awful lot. You could say if the return distribution is normally distributed. Do you know what I mean by that?
Not entirely, no.
It's that bell-shaped curve.
Right, yes, okay.
The bell-shaped curve. And what on the bell shape, if it is normally distributed, which is a big assumption, but it's not a bad assumption when we look at the data and empirically test it, I can tell you that, then the standard deviation means that roughly 66% of the monthly observations will be within one plus or minus one standard deviation of the mean. So what that says is if return distributions are normal, and we calculate, if you like, the volatility is the monthly volatility as, I don't know, let's keep our numbers nice and easy, and we get out 3% for that number. Yes. Then what it says, if the returns are normally distributed, 66 of our observations will be between -2% and +4%.
Right. Okay.
Yes. And that, yeah. And so now we've got a measure of the sort of variation or the risk of the returns.
Right. Okay. Yeah.
Yeah, because 66% of the time it's within these bounds.
Yeah.
Also,
yeah.
And what you can say also with a normal distribution is 95% of the time it's within 2 standard deviations of the mean. So that means 2 standard deviations of the mean is -5% and +7%. Because that's plus or minus 6 around the mean of 1. Okay, and that means 95% of your observations, 95% of the time your returns will be between those limits, those spreads, if it's normally distributed. So you can see now we've got a reasonable idea of the sort of risk we're taking on with this measure of standard deviation.
Yeah, okay.
Yeah. And again, that's the monthly standard deviation. Again, with the same with the return, we'd like to put it on an annualized basis. So we're saying, what is the risk in a year? Okay.
Okay.
Yeah, and this one here at the bottom, so we're looking at the square root.
Yeah.
Go from monthly to annual, we multiply by the square root of 12. And you can see that comes straight from, if you like, from this formula. I mean, we're assuming returns are uncorrelated, but from period to period, but that's a really good assumption in terms of equity returns. And so effectively, look, when we're adding up the first 12 months, we're adding up the square, we're getting 12 of them, and then we're taking the square root, and that's where the square root of 12 comes in.
Right, okay.
I mean, you can derive that, more complicated, but it's fairly, you can see that comes straight out from the fact that you're adding the squares together, taking the average of the squares. And so if you've got 12 months, it's 12 times if you like, you've got 12 of those squares, but then you're taking a square root. And so the standard deviation increases with the square root of the number of observations.
Right.
Yeah, a little bit tricky. So if you've got weekly observations, you would have you multiply by the square root of 52. And again, if you've got business day, you multiply by the square root of the number of business days, roughly 260. To go.
Yeah.
Yeah. And that means now we can calculate it. We can use observations, daily, weekly, monthly observations, and we always just scale them up. So we quote them on an annualized basis, and it really doesn't matter whether we're observing weekly or monthly or whatever, we're still quoting a number that is comparable using other frequencies.
Okay.
Yeah. So to give you an answer, for the FTSE, what we'd expect, the numbers that general people use are sort of an average return of something like 8 to 9% over a long period of time. And the standard deviation of the FTSE, annualized, is somewhere between 16 and 20%, usually. So you can see that the risk of investing in equity markets is quite high. Yes, even though the average return is high, 8% a year, that's a good return. In any year, 60%, any year 66% of the observations are between, if you like, if we assume a 20% standard deviation, are between plus 28% and minus 12%.
Yeah, that's a big deviation, isn't it?
Yeah, it's a big deviation. So it means you could lose, you know, easily more than 10% of your money in a year.
Okay.
And 95% certainty, it's now 2 standard deviations. Yeah, and so if you want to be 95%, you could actually, you know, with any degree, you could say you could lose up to 32% in 1 year.
Right. Yeah.
Yeah, and you can see why, you know, you might think investing in equity markets is quite risky. The average return is quite good. 8% a year is a good return. But
that's over a long period, isn't it? So that you've got to be prepared to have your money in there for a long, long time to get that return.
Precisely.
Yeah.
Precisely. Exactly. So that's why they say equity markets are, you know, the investment for long-term investors.
Right. Okay.
And you already immediately see that from these numbers. Yeah.
Yeah.
So, yeah, and there's a lot of people question this, but advice, if you think about investing for your pension, they'll say that's why they say, oh, you've got to start investing young, because you've got to be a long-time investor. And then if you're young and you invest in the equity markets, and sure, you might have good or bad years, but you're in for the long term, and therefore by the time you retire, you should get close to the average, return over that period, and that's quite a good return.
Okay.
And so that's the standard advice for people investing for their pension, is invest in equity young, and then as they reach retirement, start, you know, switching from equity into bonds, taking on less risk as they approach retirement, because they're no longer a long-term investor.
I see. Okay.
Yes. Now,
yeah, okay, I get that.
I mean, that is very hand wavy, and I don't want to get into the theory of it all. It actually gets a lot more complicated than that. But that is basically what your independent financial advisor will tell you.
Okay.
Okay. Now, the other thing that we want to measure is correlation, co-movements. So that's the third one. So now we're thinking of 2 series. So we've got 2 investments. And in this example, it's between the S&P, you know, the US market and the UK market. And we want to see, and we're thinking about portfolio diversification and so on. And so we're saying, look, if we put 50% of our money in the US and 50% of our money in the UK, are we getting a lot of diversification? Are we reducing our risk significantly? And so we want to look at the co-movement of these returns. And if they co-move a lot, if the US goes up at the same time the UK goes up, we're not getting a lot of diversification there. And so the benefits of being an international investor are not particularly high. If the US market behaves very differently from the UK market, and so they don't really move, you've got a lot of diversification there. And being an international investor will give you a lot of reduction in risk. So that's the sort of question we're looking at. Hello?
Hello, yeah, that's right. I'm just making a note. Yeah, that's fine. I get that. Yeah, so.
Yeah, no. I get worried that the whole thing crashes.
No, I know what you mean. No.
Okay, so that's what we're trying to
know. Kind of theory.
Yeah. So now what we're trying to look at is co-movement. So we've got the idea. We've got the idea of the mean, your average return. You've got an idea of the spread, the risk of investing in the market. And now we want to work out how much do the markets move together, and what are the benefits really for investing in the US as well as the UK? Or alternatively, what are the benefits for investing in, if you like, in a bank, HSBC, as well as an oil company, BP? So should we have more than one stock in our portfolio?
Okay.
And we get at that, and the basic statistic that's useful for that is what we call the correlation coefficient. And that's measuring the correlation. How much do these series tend to co-move?
Okay.
Yeah. And then, so we get this line is how we measure the covariance. So this is a measure of the covariance. So we have two series, R1. So let's say that's the FTSE, R1. The R's are the FTSE. S's are the S&P 500. And we want to calculate how much the US market moves in line with the FTSE. And this is the formula that we use. This measures the yeah. I'll talk a little bit about the intuition, but look, yeah, so we're taking the means off. We're not worried about the means, okay, because we're looking at co-movement. So we've taken off the mean off the R series and we've taken the mean off the S series.
Yeah, okay.
Yes. And now we look at the, if you like, the product of those two. The idea is if they're moving, if you think about if they're moving together, when this one's positive and this one's positive, that number will be positive. So if they're moving together, that term will be positive.
Yep.
This term, when this one's negative, this one will be negative as well because they're moving together. And therefore the product will also be positive. And so if they're moving a lot together, this number is going to be very, very large and positive.
Okay.
If they don't come, if they move, if you're like, they're completely anti-cyclical, they move in opposite directions, then this, if this number's positive, the R's are positive, and they're moving opposite, this one will be negative. And so the product will also be negative, a positive times negative is a negative. And so this number will be negative. Now, this one does, if you like, really badly. This one's negative, but this one's now really positive. And so we've got a negative number. And so if they're moving anti-cyclically, and we're summing them up, we're summing up all these numbers, they'll all be negative, and we'll get a very large negative number.
Okay.
So the covariance can be negative and it can be positive. If it's very positive, you've got large co-movement. If it's very negative, you've got, if you like, large anti, you know, they're moving in opposite directions. I don't know what the right term is for that. Anti-cyclical. And so this number, you know, the size of this number, whether it goes from a large negative number to a large positive number, is an indication of the co-movement.
Okay.
And this is how you write it in slightly more abbreviated notation.
Right, yeah.
Yeah. And we're going to call that the covariance. Right. Now, we're nearly there. The covariance shows us it could be a negative number or a positive number. It also, if they don't move at all together, there's no correlation, this number will be 0.
Okay. So presumably the closer you get to 0, then obviously the less movement there is that?
Yeah, the less correlation there is. And when you hit 0, then there's now no correlation, because now it's saying this one's positive, but it doesn't give you any information about this one could be negative or positive because they're not correlated. It doesn't give you any information. So this number could be positive or negative. This number could be positive and negative. And if we have a long enough series, in the end, they'll be random and they'll add up to 0. Some will be positive, some will be, yeah. And so you end up with a number like 0. Now, if you think about it for a second, the trouble with the covariance is it's going to very much depend on the volatility or the standard deviation of R and S. If the FTSE is moving up and down 20% each year, and we're summing them all up here, we're going to get a large number. If the FTSE only moves up or down plus or minus 1%, we're going to get a much smaller number here because, you know, just R moves much less.
Yep.
And so we want to kind of normalize this figure again to give us to normalize it to, you know, something that we know is going to lie, what the bounds are going to be. And so we can say, is it high or low? That's really what we want to know. We want to know if that co-movement is high or low. And that's where the correlation coefficient is. We work out the covariance and we divide it by the standard deviation of the two, of the R series and the S series.
Okay.
And then it's quite easy to show that that number must lie between -1 and 1. Yeah. And if it's -1, they're completely, you know, they're inversely correlated. If it's 1, they're perfectly correlated. And if they're non-correlated, it's 0. And you can see that's why we like the correlation coefficient, because it's normalized. We can just look at it and we know how much they co-move. And that's why, and that's the final statistic that we use. Yes, and that's the use, yeah.
Okay.
See why it must lie between 1 and -1, yes?
Yeah.
Well, if you think about, now let's correlate R with itself. So let's just assume S is equal to R. And if it's the same series, it must be perfectly correlated, yes?
Yeah, yeah.
You can't get more than that. You can't get that more than that, right?
Mm-hmm.
And so then what we have here on this line is what you're calculating is just the variance, the standard deviation squared of R, because R, what we've got now is R1 minus R times R1 minus R. It's just R1 minus R squared, which is what we had up here. Yes?
Yeah.
So we just got, so effectively here we're calculating the variance, and then we're dividing it here by, you know, we've got the covariance, and this is now just the variance of R, and we're dividing it by sigma R and sigma R again. Well, that's exactly how we calculate sigma R, and so this number becomes 1.
Okay.
And if you think about -1, well, how do we get two series that are inversely correlated? Just assume S is equal to -R. So
okay.
now if S is equal to -R, what we'll get here is minus the variance of R. Minus the variance of R divided by sigma R and sigma R again will just give you -1. Okay, so the correlation must lie between -1 and 1.
Right, okay, yeah.
You can't get more perfectly correlated than it's the series itself, and you can't get more inversely correlated than minus the series itself.
Okay.
Yep. And then that's the statistics we need to do this calculation. We don't need anything more than that. Okay.
Excellent. Okay.
So now I'm going to stop sharing these slides and I'm going to go to the spreadsheet.
Right. Okay.
Let's see if I can do that. Let's see if I can go. So I've got to go back to Google Hangouts. I can see you again, and then I can, right, go here, share that. Now, hopefully you can see a spreadsheet.
I can see a spreadsheet.
Fantastic. Technology. It's really quite good, isn't it?
It is. I haven't used this before. It's really good.
It's really quite clever. Right. So that's the series. These are, I just want to check first here that you understand these calculations. Yes. This is how we calculate the S&P total return.
So I've got G4 divided by G3. Is that right?
Yeah, that's what it says up there. What is it?
Can't see what the calculation is.
Do you see this bit here? This is the calculation we want. I don't know.
Can't quite see that.
Can you? Should I make it bigger?
Yeah, if you could. I can't quite see it.
Is that clearer now?
Ooh, I think I've got. Is that B4 minus
yeah, we
B?
still need to make it bigger. Gosh. Limits of Google Hangout now. We're finally hitting them. Okay, can you see that now?
I think it says, is it B4 divided by B3 plus C3 divided by
1,200
1200 minus 1.
Precisely. Right.
Okay, yeah.
What we got here is this is how you need to calculate it. The total return the S&P 500, is the return that you get on the price index. Remember, the S&P 500 is a price index. So what you receive if you invest in the largest 500 companies in the US is you'll get, this is the price return on the portfolio. And this gives you, if you like, the dividends that you'll receive. These are the cash distributions. And your total return is the sum of that.
Yeah.
So in this month, which is from the 31st of January until the 28th of February, so it's in fact February, so this is a return in February 1970. On your investment, you've invested in the S&P 500. The price has gone up from 85 to 89.
Okay.
And therefore, the percentage return is B4 divided by B3 minus 1. So that gives you the return, the percentage return on your investment.
Yeah.
But you also received a dividend. So this is the dividend you received in that month.
Yeah.
And that's always quoted as an annualized percentage. Yes. So the dividend yield is 3.73% per year. Right. So you've got to divide by 12 to make it a monthly number.
Yep.
And then divide it by 100 again, because it's quoted as a percentage.
Right. Okay.
Yeah. So that's where the 1200 comes from.
Okay.
And so that gives you the return for investing in the S&P 500 is if you like, the price appreciation, which is B4 divided by B3 minus 1, plus the dividend, which is C3 over 1,200, which gives you the income you're getting. And therefore your total return.
Sorry, but what you said there then, so you said that it should be, say, B4 divided by B3 minus 1, but then it's written as B4 divided by B3 plus B3.
Oh, it won't make any difference if I do this.
Oh, right, okay, it doesn't make it, okay, mathematically doesn't make a difference. Okay, right, I'm with you, okay.
It doesn't make any, the order you do it, doesn't it? Yeah.
Okay, that's fine, that's fine.
Yeah, so if I wrote it like this, a bracket in, and there you can see that what's in the brackets is the price appreciation, and then the C3
right, okay,
income. Yeah,
fine, okay,
and that worked out is 5.58%.
Okay.
Yes, the FTSE that month calculated in exactly the same way. It's these two terms. Yep. Yeah. The FTSE only had a return of when it did the value, minus 4%.
Okay.
Okay, so it doesn't look like they're not really moving together there very much. The co-movement is very high. Okay. But if you look down here, you can see
they're more aligned.
Yeah, they're more aligned. So they're, this one they're not. So there is some co-movement there, but it's not perfect by any means at all. Just looking at that data. On government bonds, that's a lot easier. There's no, it's an index. It includes the coupon payments, the bond total return. It's a total return index. You just look at the percentage return.
Okay.
And I put that one here. This is the one on T-bills. So bonds are long term. I think it's 10-year. Yeah, it's a 10-year index. So that's investing in 10-year bonds, US bonds, and the other one is investing in T-bills, which average about sort of 6 months to a year.
Okay.
Right. Okay. And you can see the returns. And you can see the point here is that the T-bills, which is short-term investment, look at the returns there. They're not very volatile at all. It's a pretty safe investment.
No. Okay. I get that. Yeah.
Whereas you look at long bonds, you can see there's some volatility there, and that's the price movement. Yes.
Yeah. Okay.
And then you compare bonds to equity, and you can see that equity is a lot more risky than the bonds. Scrolling down. Yeah.
Okay. Yeah.
Yeah. So that's an important piece of information. All right. Okay. Now. I think can you see that one now? That spreadsheet.
Still seeing the same one, I think.
Can't you? Oh, you can't see that one. So okay, I've got to go stop. Okay, I've got to go back to Google Hangouts. Sorry, and I've got to share again. Okay. Right. Can you see that one?
Yeah, got it now. Yeah.
Okay, I think this one's on the hub too. It's the answer. Yeah.
Okay.
I think you can download this one as well. So
is this the one that you download once you've done the
exercise? Absolutely.
Okay. Yeah.
Yeah. So there's the data and there's the answer.
Okay, fine.
Okay, and what I've done here is I've calculated those statistics, showed you how to calculate the statistics that we've just been in the spreadsheet. Okay, this is the monthly. So these are monthly, and then here they're annualized. So here's the monthly. Yeah, so this is the S&P 500. We've got the returns here. So that was calculated. We talked about how we calculated. That's on the previous spreadsheet. 5.58% and so on going down here.
Yeah.
These are ones for the FTSE. If we just, can you see that, or do I need to blur that up as well?
Hang on. What did you have? Yeah, the average. Yeah, I think the sum of B4 to B547. Is that right?
That's correct. Yeah. So that's just calculating the mean for us. It's just adding them all up and divided by, well, we've got 543 observations there.
Okay.
Oh, sorry, 544. Yeah, so it's adding them all up and dividing by 544.
Okay.
That's great. And if you do that on the S&P 500, you'll see 0.94. So it's very close to that 1% I was talking about earlier.
Yep.
Just slightly under it. And then down here, all I've done is multiply it by 12, and let's put it at an annualized rate according to the slides.
Okay.
So the S&P over this period has delivered on average about 11% return.
Okay.
Okay. Here's the FTSE. You can see we're just doing the same average now for the FTSE, and it is over this period. It's not statistically any different. It's just over 1%. But that means the FTSE gave on average 12% return over this 46 years.
But it's a lot more volatile.
It's a bit more volatile, yeah. That's a good point. So we'll focus on the volatility now. And we've just used, so that's using that formula, but you can do it does it very easily in Excel. We just calculate the standard deviation of all those series. So that's Excel doing that calculation for us. What it's effectively done is taken off the mean of all those observations. It's squared them, summed them all up, divided by 544, and taken the square root.
Okay.
Okay, and ended up with a number that is 4.41%. So 0.4%, just over close to 4.5%, 4.5% per month. To calculate what that means on an annualized basis, that's this one. We multiply it, as we discussed, by the square root of 12.
Okay. Yeah. Okay.
Okay, so yes, you're right. So that's the number we get for the S&P 500. That's the number we get for the FTSE. More volatile, 22%. Yeah.
Yeah. Okay.
Okay. So yeah, and we can see here for the bond index, it gives us a slightly lower return. Well, actually, it did all right. 8%, slightly lower return, but a much less risk.
Okay. Yeah, I get that. Okay.
Okay. And people have looked at that, looked at those numbers, and you can see there's an awful lot of investments out there now saying actually bonds are quite good. Bonds are giving you a good return for much less risk. And there's a lot of, Bridgewater and AQL and all. They're running these sort of, what they call it is risk parity. If you did a quick sort of Google for risk parity portfolios. What they say is you should take on investments in proportion to their risk. And if you do that, then bonds look really good. And therefore, if you look at the historical performance of these risk parity portfolios, they're very heavily weighted to bonds. And wow, look at that. What a brilliant investment that was. So actually understanding the market is very easy when you look at these numbers. It's all based on historical returns. Now, as soon as you think about it a little bit more, it's actually a lot more complicated than that. Why have bonds done so well? Well, if you think about it, we're measuring since 1970. Nominal interest rates have fallen dramatically over that period. I mean, in the US, interest rates were up at 15–16% in the 70s, early 80s.
Yeah.
Right? And since then, interest rates have fallen down and now we're near zero.
So what you're saying is if you were to take, say, the last 5 or 6 years in terms of bonds, then it would distort the figures significantly.
Whether the returns will be a lot lower. Well, you've had what's happened. Remember, prices move inversely to interest rates. Yes?
Yeah.
If the yield falls, the price goes up.
Yeah.
What's happened over these 46 years is interest rates have slowly fallen. And so you've got this huge capital appreciation going on. Prices have just gone up of these bonds slowly over time.
Okay.
And that's given investors a good return historically. But going forward, prices can't go up any more. Interest rates are at zero.
Yeah.
So going forward, one really can't expect bonds to give you the same return as they've given you in the past.
Yeah.
Yeah. Okay.
Yeah. That makes sense.
Yeah. So it's just, but the market, these risk parity portfolios are all the fashion at the moment. They're sold and so on. Right. The final one we want to know is correlations. Okay. And here are the correlations. And look, again, that's how we do it in Excel. It automatically uses that function correlation.
Okay.
Yeah. And because it's a normalized number, we don't have to worry about annualizing it or anything. It's already been normalized because we divided by the standard deviation. It lies between effectively, because it's a number between -1 and 1. It's already been normalized, so there's no worrying about it. Yeah, it's 0.6. So the correlation, that's that co-movement. It's quite high between the UK and the US on average. That correlation 0.6. That's quite a strong co-movement. And then you can see between these indices and bond indices, much lower, pretty close to zero. The returns to the bond index, on average, over the whole of this period, has been very close to zero. Right, but that belies a lot of action over time. So now the final part of the question of this calculation was, let's drill down and look over 5 years and see how it's varied over this period. Yes?
Yeah, okay.
And that's what's plotted on this graph. So let's just look at how we've done that. So I go down here, I scroll down. Can you see this?
Yeah.
And what I've done here, that's just the correlation over, you can see that's over B4 to B64. So that's over 5 years. That's 60 monthly observations, which is 5 years. And that's the correlation over the 5 years between the S&P 500 and the FTSE 500. And then I just, if you like, roll down. So I do, it's just a rolling correlation. That's what we tend to do. But it's just the correlation over the previous 5 years. And you can, and then move on 1 month at a time.
Okay.
And then this is the same one, but this is now between the FTSE and the bonds. Sorry, the S&P 500 and the bonds.
Right. Okay.
Yeah. So, and then we just, again, we roll it over a month at a time, and that goes to all these observations here. Yes.
Yeah.
And we do that all the way. And then finally at the top is just a graph of what happens. And so what we observe, the purple is the correlation, the 5 rolling correlation between the S&P 500 and the FTSE. And the point I wanted you to pick up with when you look at the data is that this has risen dramatically over time. Markets have become more global. There's been more international investment. And because of that, the markets have become more correlated. And so currently, over the last 4 or 5 years, the correlation has been up then almost at 0.9. Very highly correlated. And you see this right across the globe, in fact. The markets have become more and more correlated. If I looked at between, for example, I mean, Japan's a good one. I mean, Japan's a slightly idiosyncratic. I don't know what the Japanese market is, always a bit of an anomaly. It seems to behave almost very independently of other markets. So you get a lot of diversification for investing in Japan, which made it very attractive. Unfortunately, average returns in Japan have been very low over the last, since the crash, the Nikkei crash.
Yeah.
In the late night, right at the end, 89. The market hasn't done very well. It's moved sideways, and so returns are very low. But diversify, for some reason, Japanese seems to behave a rule unto itself, and the correlations are very low. But even those correlations have been rising over the last 40, 50 years.
Yep.
And you'll see correlations rising even between sort of the US and places like the Saudi Arabian market, or, stuff. More and more international investment has meant that people now are investing across all different markets, and that has led to a rise in correlations. So that's kind of what I wanted you to pick up on that. And that's the, yeah. And then the bonds, the blue one, this blue line here is with bonds. And this is more puzzle. This still is an area of massive research. And look at how those correlations have moved over time. What you got, this is so the first thing to bring out is this jump here in October the 19th, 1987.
Mm-hmm.
And this is when on Black Monday or whatever it was in October, this is when the Wall Street, the S&P 500, the whole of Wall Street just crashed. And I think over those 3 days, there was a sort of fall of almost 30% in the US market.
Okay.
But no apparent economic reason other than the market was getting a bit jittery and thought perhaps the equity markets were overvalued and so on. And then there was a fall. I think the story goes because of various products in the market at the time, portfolio insurance, that amplified this effect. And you got this dramatic fall on Wall Street over those few days.
Right.
What it means is now when you're calculating correlations is that you've got this huge outlier in your data. Yes. And that huge outlier has a massive impact on these statistics. It's no longer are they behaving like a normal distribution. You've got this massive number in the middle of your series, and it causes your rolling correlations to jump. And here it jumps down. This one jumps up because it was positively correlated with the UK. It was negatively correlated with bond markets. And you saw this massive drop down. And then 5 years later, when those observations drop out of the series, you see them return back to what they were before.
Yeah.
Okay. So you've got to be a bit careful with these rolling correlations, because if you get these outliers and you get these sudden jumps, it's because of these outliers in the series. Okay, so that's that. We know what it is. It's not particularly interesting. We know it was a massive crash. What we really want to focus on is this dramatic change.
Yep.
Yeah, round about, the 2000s, round about the tech.
Okay, so yeah, that one, there's one below 2005, between 2005 and 2010, there's a big drop, and then 2000, yeah, okay.
2000s, yeah. So it went from a positive correlation to negative, strongly negative.
Yeah.
Right. Okay, and that's a massive change in market behavior. Yeah, and that is a focus of a lot of research. And and quickly, the argument that's going on here is all to do with what's happened to inflation. So just to give you a very quick summary, inflation used to be a lot higher. It was, reached, in the UK at 25% in the 70s. It was high again in the 80s. It was brought down by, if you like, tight monetary policy during the 80s. But then it took off again in the early 90s, and there was inflation took off again in the 90s. Didn't reach as high as it was in the 70s and 80s, but it did rise to quite around about, I can't remember the peak, 8-9%, I think, inflation.
Yeah,
rates went up to 12-13% around about then. So again, there was a high inflationary environment, and slowly, and then inflation was brought under control round about the mid-90s, yes, and has been low ever since, really. Right, so that's the big structural change, is the way, inflation. And what they're arguing is when inflation was high, what was moving interest rates was the inflation. Interest rates went up when inflation went up. And they also so interest rates went up, prices went down. And also inflation was thought to be bad for, if you like, stock markets too. And therefore stock markets went down. So bond prices were going down and stock markets were going down at the same time, both driven by a sort of the underlying cause being changes to inflation. And therefore they were highly correlated. Well, not fairly highly correlated, right? Then in a low inflation environment, we're in here, we're now, yes. And the argument is it's a very different type of behavior that's going on. Now, because inflation is under control, inflation is not a driving factor anymore. What it is the economic cycle. So when the economic cycle is good, everyone wants to go into equity and they're moving out of bonds. And therefore the equity markets does well, but they're selling their bonds to buy equity, and therefore the bond market does badly, and therefore they're inversely correlated. And in the opposite, when there's a crash, and a sudden, a crash, and the stock market falls down, so the prices drop, everyone gets scared, and they go to a safe haven, which is bonds, and so they buy bonds, and the price of bonds goes up. And so again, they're negatively correlated. Okay. Tricky, but it's in the data. That's what makes financial markets interesting. I mean, the real change in behavior there over time.
Okay, that makes sense.
It makes it. I mean, I'm not saying, I'm giving you a very hand-wavy argument, and you could, and lots of things there. If you were being rigorous about it, you would take issue with. But that's roughly a sort of a quick summary of the arguments. And yeah, you can see this massive change, a massive change. And
so essentially what you're saying there is that when things are going well, people probably get more and more confident. They invest more, they perhaps take more and more risk. Then it hits a sort of ceiling, crashes, people panic, and then they go almost the complete opposite to then risk averse or more risk averse. Then they start investing in bonds. Then gradually, as they stop, that starts going through. They then get a bit more confident gradually, and then it starts to turn the other way again. Is that kind of that sort of cycle of how it works?
But you've put in a behavioural sort of spin on it. That people are getting overconfident and then underconfident. I tended to explain it in terms of the economic cycle, but yes, yeah,
okay,
precisely. I mean, you've got rational exuberance in your story. So yours was driven by people's behavior and overconfidence. I was trying to argue it was being driven by the economic cycle, but yes, you're right.
Well, I suppose the two at some points will work slightly hand in hand, don't they? So
exactly, they will.
Yeah.
Well, they're likely to. Absolutely, yeah. People's confidence is not going to rise as the markets are crashing.
Yeah.
So yes, that's the kind of story, and that's driving the behavior here between bonds and equity. But back here, we were in a high inflation environment, so it's a very different sort of behavior that's going on.
Fantastic.
Okay, so that's the calculations. That's how you look at the data and look at what's happening. And it's, you know, trying to show you that, you know, there's quite a lot to think about, even at this very, you know, even at the aggregate level, there's a lot of activity going on.
Yeah. That's fantastic. Thank you.
Okay. Right, so I'll stop sharing that.
Okay.
I'll go back. Okay, there you are. We're back.
Brilliant. So just with, so I mean, I've looked at those sort of three types of things, the maths, this, I don't know, I've written it now. Hang on, I've got the wrong page. So you've got mean, standard deviation, correlation. With regards to, like, you know, some of the others, are there any other sort of key mathematical things that it'd be worth me going and looking in? Like, I mean, you know, I know we're looking at
more generally.
Yeah.
Well, the other no, I mean, in terms of statistics, you will get away with that if you understand those three. Yes.
Okay.
I mean, I do go into, you know, normal distributions a little bit, but I mean, we really keep it so simple on the mathematical level because, you know, people have very different backgrounds on the course. Yeah. It's very hard to think about risk without thinking about and portfolio theory without having a reasonable understanding of standard deviations and correlations.
Right. Okay.
Yeah. So the other thing that mathematically, I also need you to be able to, you know, manipulate equations. When we get to session 8, yeah, I need you to be able to, you know, write down an equation and then it'd be a capital structure equation for maybe for the cost of capital, and then make, you know, like the returns, the capital shares, the subject to that formula, and so on.
Yeah. Okay.
So, I mean, with those two basic mathematical skills, I mean, you'll easily pass. You can easily get a good mark. I mean, there might be, you know, slightly stretched at 1 or 2 questions, but I mean, predominantly you'll be there. You could get a really good mark on the basic with those mathematical concepts.
And are most of the formulas in the exam as well, or do we need to know all the formulas before we go in?
And this is historical reasons, and you know, there is a formula sheet. If you look at the exam sheets on the hub, you'll see there's a formula sheet. And the formula sheet really has all the formulas right the way through from session 1 to session 7. They're all there.
Okay.
Session 8, they're not on there. Yeah. And session 9. So you have to remember 2 formulas from session 8 and session 9.
Okay.
Okay, but the others are all there. I mean, yeah. And then, so it's about 3 you have to remember. And maybe, I think there'd be an argument for putting them on the formula sheet. We haven't done that.
Okay.
So yes, you need to know the sort of the WACC formulas on the formula sheet, but you need to effectively remember how to calculate the beta or adjust the beta for the capital mix, capital structure of the firm. So there's that formula, and then there's the cash and carry arbitrage formula for pricing future, which you'll have to remember.
Okay.
But
I mean, essentially, on some of those, as long as I do equations and manipulate them, then effectively there's a big chunk of it. So as long as I know which bit to put in which part of the equation, then you know you should be able to do it.
You should be able to do it, exactly. Yeah. I mean, underlying it, I'm not trying to test your maths. I'm trying to test your understanding. And once you know what this formula stands for and what it's measuring, and why the future price is related to the underlying underlying price or stock price, if it's a financial future, you're away. You're away.
Cool.
Okay.
Yeah, brilliant.
Yeah. I'm going to press. Yeah, Chris, we're going to send me an email for whatever if you get any further issues. Yeah.
No, that's fantastic. Thank you very, very much.
And good luck.
Brilliant. Thank you.
Cheers.
Thanks for your time.
Bye-bye.